Welcome to the Art of Money podcast with Art McPherson.
And this is the Art of Money podcast with Art McPherson and Luke McCarty, artofmoneyradio.com for more information on the McPherson Financial Group or to schedule that initial complimentary consultation. We appreciate you listening. Now, let's get to the show. I know this is going to be kind of a basic question, but how much will the upcoming election, how much will that affect our overall retirement and financial plan? Are we overthinking it, or it really might have an effect on, things moving forward?
It really might have an effect. I mean, every midterm year since 1950, the stock market has rallied into the midterms. So, this year has been one for the history books to not follow the history books. Mm-hmm. But, when we think about what the stock market usually does and what the stock market wants, the stock market wants gridlock in the government. So, right now we have a Democrat sweep, right? The president, the House, the Senate. So if the Republicans can take one of, the House or the Senate, it's going to not allow the government to make a lot of changes in the future, or at least for the next 2 years. And so that's actually a positive for the stock market, because the stock market in general, does not like uncertainty. Mm-hmm. Our opinions and some thoughts we have, if the Republicans, don't take the House or the Senate, we could be looking at tax reform, a full sliding sweep of the Donald Trump tax cuts. But that can't happen theoretically if the Republicans take the House or the Senate. So it's just history tells us the market should pull through, but this year has not been one to follow history.
It's also the important reason of having that plan. You can at least begin the conversation about putting that plan together. Again, the event coming up Thursday, November the 10th at River Rocks, artofmoneyradio.com, or to reserve your space, 321-425-8550. And we're talking about the recession this weekend here on the Art of Money. And one of the difficult things about a recession is, we don't know when it starts until much later. That hindsight's always 2020. Well, billionaire hedge fund manager Paul Tudor Jones tells CNBC that even he isn't really sure if we're in a recession right now.
I'm assuming we're going to go into one. There's a specific playbook around that. Well, so that playbook is most recessions last about 300 days. From the commencement of it, the stock market's down, say, 10%. When we get into that recession, there will be a point when the Fed stops hiking. There will be a point when it starts to either slow down, or even at some point, it'll reverse those cuts. And when that happens, you'll probably have a massive rally in a variety of beaten down inflation trades.
All right, so the cliche, our recession playbook. What is yours telling you? What should we be doing, Luke McCarty?
Yeah, I agree with Paul on some of the things he said. Now, I don't agree with his recession, the stock market down 10%. We're down a lot more than that, the stock market in general. But the stock market, when looking back on history, it always seems obvious when you're looking back, but the current timing of where you're at, there's a lot of unknowns. And so when we think about a recession, right, can we be in one right now? Possibly. The market's down 25-30%. The bond market is in a recession if we're thinking of it from a price perspective. And so, your playbook this year needs to be, to pull, if you need income for retirement, you need to pull money from buckets that haven't lost money, or, spend your dividends, have a playbook that says, when the market goes through these types of corrections, here's what I'm going to do. Here's what my plan tells me to do. And when the Fed slows down or cuts rates, when they pivot and kind of change guidance, that's going to be, very good for the bond market. And historically, it's been good for the stock market as well, mm-hmm. to own, those technology companies when rates are coming down. Own a bond since 1982 and you've made money except for last year and this year, as rates have gone down over time. So when the Fed changes guidance, it's going to change the stock market.
So even though we are technically in a recession right now, 2 months of negative GDP growth, you've said it before, Art McPherson, you've said it before, that we do think that 2023, regardless of what happens with the midterms, it's probably going to get a little bit worse.
It's looking like the Fed needs to make it worse, mm-hmm. to fight inflation. And that's the fear right now is, the federal funds rate getting to 5 or 6%. Right now what's priced in is 4.5%. So any further hikes past this year is going to cause a little more stress to the bond market, to the stock market, to the economy.
All right. Well, that's what I always talk about here on The Art of Money, that importance of having a plan, because, Luke McCarty, Art McPherson, they don't have that crystal ball, but we can put that plan together to help protect your assets and even build income in retirement. 321-425-8550. And Luke, the amount of money lost in retirement plans this year is gut-wrenching. Economists say that inflation and its impact on the markets have taken an average of 25% off our 401ks. That's an estimated $2.1 trillion. So, Luke, while the experts try to decide if the market has reached a bottom, could this also present a possible opportunity?
There's definitely opportunities, at the back end of a bear market or the back end of a recession. When looking at prices right now, you can get a stock that's historically performed really well or a very strong company at 25 to 30% discount. If I tell my wife that, she's going to Target all day, 25% off, whether we need it or not. And so if you're still buyers in the stock market, it presents an opportunity. If you're not a buyer, let's say you're retired and you don't have the income coming in or the 401k, well, now's a chance to take some assets that haven't lost money during this last year and shift them. Right, kind of rebalance your whole portfolio. If you have X amount in cash, well, that didn't lose money. Now it's time to buy some stocks. Mm-hmm. If you have X amount in an investment that hasn't lost money, like an annuity or a preferred stock or, you name it, it's a good opportunity to potentially look at kind of trying to buy something discounted that you couldn't have bought last year.
We talked about here last week here on The Art of Money how everything's more expensive, and this being Halloween weekend, you were 100% correct about even Halloween candies become more expensive. You know how much we got like a bag of like Kit Kat and Snickers and the little mini bars? It was like $15.
How many bags did you get?
Well, I got one for the kids, 3 for me, but that's not the point. The point is, Luke, and now they're saying it's almost like they're preparing us for the worst. Do you see that there's a turkey shortage? And they're saying with Thanksgiving coming up next, prepare to pay for upwards of 75% more for your turkey this year.
Wow.
Yep.
I hope not.
Yep.
I eat turkey on Thanksgiving, but if it were that good, I'd eat it more than once a year.
True. But a lot of work.
Yeah, the cost of candy's gone extremely up. I'm having a barbecue at my house on Halloween. Uh-huh. That's gone up. The cost of tri-tip, that's what I'm smoking for Halloween, has gone from, $6 a pound to $13 a pound.
Goodness.
So when thinking of inflation being 8.1%, everything we talk about, Mark, is up more than 8.1%.
Okay, you've said it before here on The Art of Money. Core inflation. What is core inflation?
So core inflation is a component of the CPI. So the CPI report is what came out last month at 8.2%, potentially peaked in June of 9.1%. But there's another internal, like the core CPI is inflation minus food and energy. Mm-hmm. And its big component of that is housing. And that is still rising. So we see that rising. We can kind of, look at the traditional CPI index rising a little bit more as the price of diesel fuel continues to go up. And so there's still a lot of headwinds for the Federal Reserve where we think they're going to keep increasing rates. I don't think they're going to pivot, meaning I don't think they're going to cut rates, but they may slow down next year in 2023 and just see how things play out.
That's the importance of having that plan. And so tell them what's going to happen next, but we do know that everything is more expensive right now. 321-425-8550. And before we get out of here on this segment, it's common that we get into a rut and we feel like that we're kind of on autopilot. We've talked about clients who take an autopilot method of investing with target date funds. They just kind of set it and forget it. So how do you get retirees out of that rut and begin to personalize a better plan? Or is it just sometimes better just to leave some of these investments alone, Luke?
Sure. It depends what kind of investments, we're talking about or what kind of investments you have. But, when we're thinking specifically to target date funds, a lot of those are available in your 401k. They can be available in an IRA, so we can use those for our clients here. We don't, because the issue with target date funds is, let's say you have a Fidelity Target 2025. Well, it's going to be, 14 Fidelity funds under that one ticker, under that one investment. Mm-hmm. And what a lot of these target date funds do that we do a little differently is they have a lot of international exposure. We just saw Chinese stocks in the Hong Kong index, and a lot of international stocks are performing terribly this year, especially even last week. And there's just a lot more risk out there when the dollar is this strong. And I don't think the target date funds really look at that. They just kind of have their allocation based on, the date you're expected to retire. And they put X amount in this bucket and they keep it what it is. Mm-hmm. So it's just not very active. It's very passive, with a lot more international, in my opinion.
If you have a question about your target date fund, some of your investments, is it better to kind of leave them alone or maybe make some adjustments? Give the team a call. Let's sit down. Let's have that conversation. It's no cost, no obligation to you with the team at the McPherson Financial Group. 321-425-8550.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com.
We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson, Florida Insurance License number A174725.
Today's show has been a work of art.